Good evening to one and all. I welcome you today in WOW series on which CA Rati Oak, our expert faculty, is going to talk on ESOP, key insights on structure, accounting implications, and taxation benefits. Before proceeding for today's session, may I request WIRC technical team to play our ICI motto, and I request everyone to put your hand on your heart.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Friends, all of us, we know ESOPs are commonly used as a motivational tool, encouraging employees to work towards the company's performance and success on one hand, and to encourage long-term commitment or other. For this, we have none other than CA Rati O, who is having, who's expert on the topic and having a diverse experience. And at WIRC, we have planned n number of programs and activities and seminars under the dynamic and humble leadership of Chairman CA Ketan Sayyar sir, and with the support of all regional council members. So I request you to go on WIRC website and try and participate in maximum activities as possible. And coming to our today's faculty introduction, friends, it gives me immense pleasure to introduce our today's faculty, CA Rati Oak. She has done her MCom from Pune University. She is a diploma in IFRS. Rati is having overall 14 years of post-qualification experience in accounting, financial reporting, and advisory, specializing in IFRS and Ind AS. She has diverse professional background across banking, IT, startups, corporate finance, and consulting industries. She has led multiple finance transformation initiatives, including ERP implementation, process implementation, and strategic financial planning, such as FP&A, budgeting, and investor management. She is currently working with Browser Stack, a global SaaS company, where she leads consolidation, treasury, and ESOPs and month-end close processes. She has also experience in setting up legal entities in the USA. She has successfully led a project to insource finance operations from USA and Europe to India. With this, I would request all of you to carry out a loud applause and let us, welcome today's our speaker, CA Rati Oak. So with this, over to you, Rati. Once again, thank you for having agreed for taking today's session, and thank you and all the very best. Looking forward.
Thank you. Thank you, CA Jinal madam. And you have given us such a great introduction, and you've set a very good tone for this session. I really appreciate the same. Hello, everybody. Good evening. I'm CA Rati Oak. I'll be talking to you, and I'm also sharing my screen. I'll be talking to you today about the ESOPs. It will be like a great introduction to ESOPs. I hope that at the end of the session, you will have definitely learned something about ESOPs. I've been working in this ESOP space for some time now. And today I would like you to introduce to the world of ESOPs through my lens. So let's begin. I would like this session to be a very interactive one. I know that you would not be able to speak up in this session because it's a webinar. However, I would want you just to specify your name, whether you are a CA or a non-CA, and which company you would work for. If you could just put that into a chat box, it will be a really good interactive session for all of us. And I would really encourage you to ask questions. You can ask the questions in the chat box, and towards the end of the session, we'll definitely have a question answer session. And at that time, we will definitely take up all those questions into consideration. So I'm just looking into the chat box now. A lot of people are joining in. That's nice. There are people from Tom, Affluence, people who are pursuing CA. That's really nice if you're doing your CA and then you're looking to gain knowledge on ESOPs. I didn't do that during my CA tenure, but it's really good. That's nice. I think we could take a look at it later on as well. If you have not put in your introductions, please do put your introduction. It will just give me an idea like who are joining, whom I'm talking to. Nice. Thanks for putting in. Yeah. So let's talk about ESOPs. You know, there are only these four-letter words, ESOP, and what do they stand for? So ESOP stands for Employee Stock Option Pool or Plan. It sometimes it's also called as ESOS, that is Employee Stock Ownership Scheme. So, but in the core, you call it ESOP or you call it ESOS. In the core, it is all about giving employees a real stake in the company they work for. Now, imagine this. You're working for a company and you're working with it as an owner. That's the power of an ESOP. It is a program that gives employees shares of the company stock, actual ownership. The better the company does, the better you do. Simple idea, right? But it can be really transformational. Think of it as it's your retirement plan, but smarter. Instead of just saving the money, you're earning equity. You grow with the company, and in turn, the company grows with you. Your goals and the company's goals then start to align. But is it that simple? But ESOPs are not like you're buying stocks on your trading app, Zerodha, HDFC Securities. No, it's not like that. These shares are not bought on stock market. They are granted by the company and they come with specific rules. These rules are conditional and usually tied to how long you stay and what milestones the company achieves. So, why does this matter to you? Because ESOPs are not just benefits, they are your wealth creation tools. They reward long term commitment. The longer you stay and contribute, the more value you can unlock. So, in today's session, we will break this down into what ESOPs are, the key advantages of it, how they are generally granted in a company, the operational way of doing things, how the accounting happens, what is the taxation part of it, what are other factors which are considered in the ESOP. Okay, I'm just checking if there are any questions. No. Okay, cool. So now we can move on to the next slide. Just give me a minute. So employee stock option or employee stock ownership plans, ESOPs, they have gained a significant traction in the corporate world. To understand the ESOPs, it is really important to know that these plans empower employees by giving them their ownership stakes in the company, typically in the form of shares of stock. As I said earlier, the concept is simple but profound. As the company prospers, so do its employees. So when we talk about ESOP, in this slide, we are going to talk about employee benefit scheme or plan, which offers employees an ownership interest in the company. Company grants an option to its employees to acquire equity shares of the company at a future date, but at a predetermined price. So generally, it is a part of the compensation package where options are vested over the defined period. There are, as I said, this is a conditional ESOPs. So there are some service and or performance conditions that need to be specified. Moving on to the next slide. So that's the next step in your ESOP journey. For example, you have received ESOPs. How does the company operate it? We'll come to the employee angle as well. But right now, we are looking at a company angle of it. There are two routes to it. That is a direct route and a trust route. Right now, what you see on the screen, it's a direct route. What does the direct route talks about? First step, company gives an option to buy shares to the employee. That means company grants ESOPs to the employees. Employee, second step, employee exercises the options via step number 2 and transfers the funds to the company. Third step, company issues equity shares to the employees. What is the next step? This is little complicated, where the employee welfare trust, the trust route comes into picture. As you can see here, in the trust route, we can see the company. The company sets up an employee welfare trust. What they do is they grant a loan and they issue shares to this in the name of this employee welfare trust. At the same time, in the graded manner, company keeps on giving the grants of options to the employees. That is the step number 3. So we have looked into step number 1, 2, and 3. Now we are going to the step number 4. As the employee has received its grants, this employee will go and exercise these options and transfer the funds to the employee welfare trust. Now, employee trust has received the options, money, and what they would do is they would go for step number 5, which is the transfer of shares to the employees. Now, employee welfare trust has received the money. So, the loan which was given by the company in the first place is repaid by this employee welfare trust to the company. That's how the trust route comes into picture. So there are 6 steps to it. These are a very basic minimal steps which we can, get into a flow chart, but that's how it works. There are 3 parties involved to it: company, trust, and employees. I'm just summarizing it. We looked into 2 modes. One is the direct mode, where only company and employee are involved. Company grants the shares to the employees, employee exercises, transfers the funds to the company, and company issues shares to the employees. That's the one. Now, which we looked into is a trust route, where there is company, trust, employee. Company first gives the loan and the shares with the trust, then grants an ESOP to employee. Employee exercises the shares, transfer the funds, trust gives the shares to the employees. And whatever loan which they had received, the company from the employee welfare trust, that is paid by the trust to the company. And this how the transaction is completed. Going to the next slide, here we are talking about the pros and cons of the direct route versus the trust route. So what are the pros of the direct route? As you can see, there are less number of steps involved. No need to create a separate legal entity. This saves times and efforts to roll out the ESOPs. Then when you are setting up a new entity, you will have to pay for the overheads of this for managing the separate entity. There would be accounting, compliance, audit, everything would be involved. And of course, when you are giving a loan and issuing shares, there would be capital gain, repayment of loan, and the complex tax and legal compliances which are involved in the trust route. In addition to that, there is also complex Ind AS or IGAP accounting which is involved when which is related to treasury shares accounting in case of trust route. Trust route is generally adopted if the shares are acquired in the secondary format. There are also FEMA, tax, compliances which are in the global setup of the companies which is required. For example, I have a company which is a Indian company and I have some employees which are of my subsidiary and the subsidiary is in the US. So that employees are USA employees. Then FEMA, tax compliances, that would come into picture. That's a very detailed topic and today we are not going to touch that. Maybe in some other session, we'll definitely consider the FEMA, tax, the inward remittances, outward remittances of it. That we will definitely consider in the next session. And right now we looked into what are the advantages and disadvantages of trust. But what is an advantage of a direct route or what are the disadvantages of the direct route? So in the direct route, as you can see, everything is quick. We do not have to spend the overheads. So, but in the direct route, the disadvantage is there the company might not have the enough bandwidth to manage this whole structure. And ESOP administration is done by a separate entity when it goes to trust route. So the bandwidth is saved, definitely. And the company does not have to dilute its existing capital base because they've already transferred the shares to the trust. So what we talked about right now, I'm just summarizing, is we talked about how the shares are issued in the companies. There are two routes to it. There is a direct route, there is a trust route. Going back to the next slide, we will talk about the accounting side of it. Say, for example, the shares are granted. What would be the accounting amount for it? So, in this case, we have to look into option pricing model. So, Ind AS 102, IFRS 2, which talks about share-based payment, recommends Black-Scholes-Morton's options pricing model for calculation of fair value of employee stock options. So this slide, we will understand how this fair value is calculated. And in the next slides, we will understand how that fair value is used in the accounting. And what are the variables considered in the option valuation? The variables considered are exercise price of the option, market price of the option, current expected dividend yield, risk-free rate of return, expected option life, volatility of the stock. Couple of factors out of this are market factors they are driven by the market. But some factors we already know them when we issue a ESOP grant. Say, for example, you're already aware of the exercise price, you're already aware of the expected option life. And under Indian GAAP, intrinsic value method is allowed for option pricing model. I'm just looking at the question. Yeah. How to go about the valuation of the companies that are not listed? Yes, we're going to cover that in the next slide. We have independent valuers for that. Those valuers would give you a value for the company. Those market factors which we are talking about, which you being an employee of the company or being in the finance team will not have, but those values, they are expert in giving you those all the valuation considerations. So we are into the share-based payment accounting. In the last slide, we saw how the fair valuation of the option pricing model happens. In this slide, we are actually looking at what is the timeline of an equity settled share option. So there are two ways of share options. One is equity settled, second is cash settled. What is equity settled? When you get an ESOP, the one which we saw in the direct and trust route, that was an equity settled option. Equity settled option, in a simple terms, is when you are exercising the option, when you get the shares of the company, that is an equity settled method. What is a cash settled method? When you are exercising an option and you're getting a cash for that, that is called cash settled options. So right now, the timeline which we are looking at is for the equity settled share options. So in the timeline, you see here a grant date. What is a grant date? So grant date is nothing but the date on which your ESOPs are granted. Now this ESOP has 4 years of vesting periods. So you have vesting periods year 1, 2, 3, 4. And after 4 years, all these shares are vested. So when you get a grant letter, in your letter, the vesting period is mentioned. So at that time, you will get to know how many years these shares are going to be vested. At what date these shares are going to be vested. And then once your shares are vested, and that time they are available to exercise. So then you will have an exercise period, which is from year 4 to time. Why I've mentioned time is because a lot of times your grants have a specific period. So your grant, for example, it's given to you today on 21st of May 2025, and the vesting will complete on 21st of May 2028. But you will have a time to exercise all those vested options till 2019. Say, for example, you've been given 1 whole year for vesting this period. Why it is important to learn these terminologies in the share option grant is that gives you a clarity when you do the accounting for it, because your accounting is dependent on all these factors which we looked into. This slide will give you the amount, that is the total expected charge for your share-based payment accounting. You know what are the options granted. This would be available to you from your grant letter. You have calculated in an earlier slide the fair value of that option using the Black-Scholes model. So you have that. Then the third factor is percentage expected to vest. How much percentage of these total number of options are expected to vest? For the time being, we assume 100% is going to be vested, and that gives you a total value of the grant date. Now, you calculate a total value of the grant, and this is spread over the vesting period. And this is credited to equity incrementally. And how it is calculated is, so I'm going back to the earlier side. So at the grant date, you calculated the grant value, and then you're going to vest it for 4 years on an incremental basis. We will come back to the incremental vesting as well. There is an important factor which I want to point out here, because earlier we said the percentage expected to vest, we are considering as 100%. I would like to talk about this additional factor here that's called cancellation rate for future vesting date. For example, I'm working in a company, I've been granted ESOPs. Vesting period is 3 years. However, I leave the company before the vesting is completed. What's the accounting scenario looks like in this case? So when the shares are granted on day one, my accounting has already started. And when I leave the company, the shares are not vested. Cancellation rate comes into picture during this time. So when you have a future vesting, you are calculating a future vesting cost. This cancellation rate is deducted, that the cost is reduced by amount of this cancellation rate. How is this cancellation rate calculated? So this is generally a management estimate. So I'll give you an example. You can take an average of last 3 years of ESOP forfeited or expired. How do you calculate ESOP forfeited or expired? You take the example which I told you. There would be few more of us where they have left before the vesting was completed. So you take the average of last 3 years of such cases, and then you calculate the rate. And that rate is applied here in the percentage expected to waste. From my personal experience, I would tell you, it is really important that you document this policy and then you continue to work with this policy, because that will help you in all your internal audits, statutory audits, and there would be a consistency in the accounting. In addition to that, it will also tell you when you are doing this activity. So when you say I'm taking average of last 3 years, you have to wait till the last day of the year and then take the average and apply that average. So you need to ensure that all the data is available to you. Companies generally have ESOP management tools which they use that would give them an idea about what is the cancellation rate, how many ESOPs are expired, how many ESOPs are canceled. So that would give you an idea about it. I'm just looking into chat because okay, I think I have some questions about the valuation, and I have one question about, can you give some examples in numbers for accounting treatment? I'll definitely give you that example. I think it's on coming on my next slide. So I think we are clear on how you are accounting for the total expected charge. It is the total number of options, which you get it from your grant letter, into the fair value of one option, into percentage expected to vest. That will give you the total value of grant date, which you would spread over the vesting period. And the important part, how do you account for it? Going to the next slide. This sites talk about what are the accounts which you have used. So when you're doing a equity settlement, that happens employee benefit expense account debit to ESOP outstanding reserve or share options outstanding account. That account comes into equity. So the first account comes into employee benefit expenses in the profit and loss account. That is the debit account. And the second account comes into ESOP outstanding reserve in equity. Okay. Going back to the next slide. Yeah. This slide, I'm sure this will definitely answer your question on the accounting part of it. So I'll take you through this example now. The grant date is 5th of May. Sorry, just... Yeah. The grant date is 5th of May 2021. The number of options issued are 100. The grant letter says 25% of the options vest every year over the graded manner for 4 years. And the fair value of option is 400 per option. Now we have plotted this down into an Excel table. Okay? First column talks about the number of options. Why it is saying 25? Because this is the 25% of the 100 options which are granted. Every year, 25% options are getting vested. So you can see 4 years, 25, 25, 25, 25. Now it is totaling to 100. So we have correctly divided all the options into 4 years. What is the second column talks about? It talks about the fair value per option. What is the fair value per option? 400 rupees. So we have plotted these 400 rupees. What would be the value of option? Value of option is nothing but 25 into 400. So this 400 is calculated by the IFRS 2 valuation methodology, the slide which we looked into earlier. Okay. So every year you have 10,000 of cost when it is vesting is happening. Now, what is the grant date? Grant date is 5th of May 2021. What is the vesting date? 4th of May 2022. So when there is graded vesting, what do you call it by graded vesting? That every year some vesting is happening. At that time, what you would do is every vesting you will consider as a separate grant. So you will say, I have one grant which is from 5th of May 2021 to 4th of May 2022. Why I'm saying 4th of May 2022? Because this is the vesting for me. So 4th of May 2022, 4th of May 2023, 4 years. So 22, 23, 24, 25. Now, what would be the expenses to be recognized in my profit and loss? So this is calculated basis the number of days. Sorry. How it is calculated is 10,000 divided by the grant period and into the number of days into that financial year. So in the financial year 21-22, when you start accounting for it, you would get 9068. If you put it into Excel, you will definitely get it. Maybe you can reach out to me later on and I can just share you the Excel working of the same. Unfortunately, I won't be able to show it in the PPT. But that's how you calculate the grant as per the vesting date. You can see that when the vesting is ending during that year, the grant charge is getting completed. That's how you're considering it. So this is ending in 4th of May 2022. That means in the year 2022-23, the grant is totally calculated. And in earlier side, we also talked about future vesting. So right now here, they have not assumed any cancellation rate. Cancellation rate is assumed to be 0, that everything is going to be vested. So you can see that in the year 2021-22, you would have to accrue for 18,888. That would be your P&L charge. And that charge will be completed in the year 25-26, when all the grants are going to be vested. I've got one question which says, is it not that expense for second year will impact only second year and not the first year? So expense of second year, which is 11,760, that is an incremental cost to 18,888. So you will have ESOP outstanding reserve, which will go up to 40,000 rupees at the end of 4 years. But in the first year, you will have only 18,888. So this grant, which is vesting on 4th of May 2022, that will not have any impact as such in the third year, because the grant is getting totally vested in the year 2022-23. I hope I was able to give you an answer. Yeah, it's a very valid question, Sakshi. Can you please explain how we arrived at 9068? Maybe I can, if I get a chance, I would be able to share this with you, the Excel working of it, because this is calculated from an Excel. I've noted it down. Hopefully, if you get a chance, I'll definitely share with you the Excel working. Or maybe you can reach out to me on LinkedIn and I can share you the working, the Excel calculations of it. For sure. Okay. I think Saurabh has some question. He said he was talking about second vesting. It must start from the second year. No, you're right. The vesting starts from the second year, but the vesting period is from 5th of May, that is the grant date, till the vesting date. So on 4th of May 2023, all your shares are vested, that is 25. On 4th of May 2020, all your shares are vested, which are 25. So your accounting starts from the grant date and it ends at the vesting date. That's how it works. The accounting does not start from the vesting date. I think Parth has already calculated and given it to them. Yeah. Sagar is asking, do we have an option to consider revised fair value for the expense recognized for the year 2, 3, and 4? No. The fair value is fixed at the grant date. Of course, there is modification in the fair value which happens, which is called ESOP modification. But we are going to talk about it at the in my next slides. Okay, I think I've closed out all the questions. Please do post your questions again if I've missed out, because in the chat it goes into the history. So please do let me know if I've missed out anything. And of course, we'll have the question answer session later on. I'm just looking at if I'm getting some more questions. Okay, I don't think I have any more questions. So I'll go back to the next slide. Yeah. Before actually I go back to the next slide, I actually want to talk about a very non-glamorous part of it. That is the taxation part of it. I'll just see if I've added a slide for that. Yes, I have a slide for that, taxation. So you've heard about ESOPs, till now, which talks about as a way to share the company's success. But now let's talk about the taxation. We'll walk through a story from the employees and the company's perspective. So from the employee's angle, when the ESOPs are granted, whether there will be any tax involved? No, there will not be any tax. Why? Because you have only been promised a share. You've not been owner of the share. So that's why there is no tax at the grant from the employee's perspective. What happens when the ESOPs vest? Your ESOPs are vested. You have now become eligible to exercise your options. Have you exercised it yet? No, not yet. If you've not exercised, you are not holding the shares. You still have an option to buy them now. So there will be no tax yet. Then comes the third part, is the exercise. What happens when you exercise? That time, the activities involved are, you buy the shares at the exercise price. Where do you get the exercise price? You get that exercise price into your grant letter. If the market value of the share is more than the exercise price, the difference is taxed as perquisite. That is, difference is taxed as salary income. It is added to your income and taxed as per your slab. So you would pay TDS on salary. out of your salary slip. And tax is paid in the year of exercise. So the taxation event technically occurs at the time of exercise. Then the fourth event, that is when you actually make the money. That's when you sell the shares. When you sell the shares, that's the time of capital gain tax. Depending upon the periodicity of you holding the shares, there would be either short term capital gain or there would be long term capital gain. And how is this capital gain calculated? The money which you have received minus the fair market value on the date of exercise. So the exercise price, it's really important because that price into your sale price, that would be taxed to you at as capital gain. And depending upon the periodicity, that would be short-term capital gain or a long-term capital gain. I think I've got some questions. Let me just take a look at it. Yeah. I've got one question about if employer, that is the company, is situated outside of India and Indian employee exercises the option, what will be the tax implications? So I have looked into this scenario, worked into this scenario. I had a holding company in Europe, and entity was a subsidiary of that Denmark based entity, Indian subsidiary. Sitting in India, the Indian employees, they were getting shares of the Denmark based company. When they would exercise the shares, at that time they would pay TDS on salary. And how this structure was done was, it was shown as the Denmark based company, by way of transfer pricing rules, they were doing an ESOP cross charge to Indian entity for the subsidiary ESOP shares which they had. Those are the cost which we calculated in earlier slide, the cost which was associated to or related to Indian employees, which was moved here. And that's the reason we paid TDS on salary. That's the same thing, perquisite tax, which we considered on. So that's how we did that. And even the capital gain tax was applicable when we sold the Denmark company shares. But of course, there are other factors to it. You can submit a TRC, that's the tax residency certificate, and you would be able to save the tax. All these factors will come into picture. So right now, I'm not focusing on the foreign factors of it. I'm actually focusing on only the Indian factors of it, because there are lot many factors, FEMA regulations and taxation impact that would be involved. Okay. I've got one question. Under the Indian GAAP, can a private limited company use binomial method for option pricing and fair value method of accounting? So as far as I have worked in Indian GAAP, we have always used intrinsic value method for that. I'm not sure about that, but I'll come back to you, Bhavin, on this query. Okay. Yeah. So in case the employee who has left the organization and exercises the options after 2 years of resignation, in such a case, how the TDS can be calculated. So, Nimish, I've not technically seen this kind of scenario. In my old organization where I worked, when an employee leaves, within like next 60 days, they had to actually exercise their options. They were not given like 2 years to exercise the options. So when they exercise the options within 60 days, their FNF was definitely on hold, and then we used to consider as a TDS on salary. But it's a very good question. Let me come back to you on this one, Nimish, because I have not looked into this kind of scenario. Sorry, back to this. Yeah. we only discussed about what is the employee tax angle. Now let's look into from the company's angle. So when you're granting an ESOPs to your employees, what is the taxation for the company? So there at that time there is technically no direct tax benefit, but the company starts recording a non-cash expenses, that is the ESOP cost. As we saw in our earlier slide, there is ESOP cost which is debited and it is credited to ESOP outstanding reserve. That is an equity. So the estimated cost of ESOP, that's the non-cash expense which we are accounting for. So this expense which you have booked reduces the taxable profit. So there is definitely an indirect tax benefit over time for the company. What happens when the employee exercises the option? When employee exercises the option, the company, as I said, there would be TDS on salary. So company withholds tax, that is TDS on salary, on the perquisite value and reports it as a part of your employee salary. This is and of course, this is also a compliance obligation. And, failure to deduct TDS can attract penalties. Third, now we're coming to the fourth scenario, which is sale of shares. What happens at the time of sale of shares? If the company buys back shares, like when an employee is selling, whether the company is buying or they are selling in the open market, at that time there will be a capital transaction for the company. In addition to that, company also needs to pay buyback tax, especially in India, and in listed companies, other taxes may apply when it goes to sale of shares into the market. Then I also would like to, talk about one more point is uh, these perquisites, which are taxed as employee income. What is this perquisite? That is the fair market value minus exercise price, which is at the exercise step. That can often be claimed by companies as deductible business expense. What happens is this reduces companies' taxable income and creating a real tax advantage of rewarding employees via ESOPs. So that's an additional advantage for the companies. So let's do a quick recap. Employee tax and company tax. Whether there would be any employee tax at the grant, at the vesting, no. At the exercise, yes. Perquisites taxed as salary. At the sale of shares, yes. Capital gain tax depending upon the periodicity. What would be the thing for company tax? At the time of grant, no direct tax benefit, but the indirect tax benefit because the cash would be cash expenses, non-cash expenses would be accounted for. At the time of vesting, no really change as such. What happens at the time of exercise? The same TDS compliance in the case of employees that would flow into company tax impacts, and then there will be a deduction of expenses also, which we talked about, and sale of shares. So there would be a possible buyback tax or a transaction impact that would come into picture. So now we've talked about very technical aspects about accounting, taxation. Now I want to talk about one topic, which is buyback. And that adds a real value for the company. I'll tell you a very quick example about that. I'll go to that slide. So what is a buyback? There could be buyback of ESOPs as well, options, not buyback of shares. So let me tell you a quick story. Once upon a time, there was a startup. It was like a buzzing co-working space. There was like fast growing company called Novatech. This is a fictional story, definitely. Okay, the names I've just picked up. They were building an amazing AI product and had a super talented team behind it. Everything looked great on the outside, But there was one big issue. Employees had stocks, but no cash. They were promised equity with a notion that when we go public, you will be rich. But the IPO kept getting delayed. And in real life, what happened in the real life? Employees had to pay the rents, some wanted to buy houses, and others also had families to support. So having equity on paper or having just value on paper did not help them today. So some of the employees had joined the company at lower salaries. They believed in the company's dream. But after a few years, they started asking questions, when can we actually use this equity? They were loyal, but life doesn't wait for IPOs. Company's founder got a hint of it. The founders sat with the team, with an expert team, and asked a big question. The question was, how can we help our team to get real value from the shares before going public? They explored few ideas. So one was tender offers. What is a tender offer? So let the company or the investors buy back the employees' shares. Secondary sale. What is a secondary sale? Allow employees to sell the shares to outside investors. Loan program. Let them borrow money using their shares as collateral. Surrender options. Give up a part of future equity to get some cash flow. Say, for example, I have an ESOP which is vested. I've not exercised it yet. The founders, the company, the investors, they will buy back that ESOP and they will release the cash to the employees. And the companies decided to go for the last option, which is surrender of options. Employees, some of them, they actually chose to surrender part of their invested stock money right now. It it was a win-win situation. Employees got the funds they needed. The company managed the dilution. How did they manage the dilution? None of the new investors came into picture. The shares were not gone to somebody else outside of the company. The investors' percentage in the company remained at it. And everybody was motivated out of this. They worked with like a smart investor to make it like a tax efficient, fair, and good for retention option. Once this option was exercised, there was a big culture shift. The whole vibe changed. The team morale improved. Trust in leadership grew. Word spread that Novatech actually cared about its people. They started, in fact, attracting even more top talent and people who loved the company's values. And what is an epilogue of it? When the IPO finally happened, it was a huge success. But here's the thing, the employees were already winning before IPO. They had gotten a real value along the way, not just on paper, but in their pockets, and not just in the future, but they have got it in the present. So, the big takeaway from this story is that ESOP could be utilized in such a way as well. So, we looked into the buyback part of it. So, equity should not be a distant dream. Startups can, or companies can, they should help employees to get values before they exist. And that's how you actually build trust, loyalty, and a company that truly lasts. So this was about the slide. I'm just taking a few questions. Yes. So Nimish is asking whether the cash settlement of vested options will be considered as buyback. So in the terminology, it is called surrender of vested options. Yes, because the company is buying back my right to acquire the shares of the company. That's right. And how does the surrender of option works? I'll tell you. I've seen it in real scenario. It really boosts the morale of the employees, and they actually get the money because the IPO is dependent on the market factors and all the other factors which are not in the employees' hands. And they have really put in their hard work and time into building this company. So how does it happen is, say for example, Nimish, you have 100 stock options at 25 rupees each. Now the company is buying back that option at 500 rupees each. So what you get from the company is you get 500 minus 25 rupees into number of options which you want to surrender. That would be 100. So that much money you will get for that. And there would be taxation part on this as well. That's how it is. Okay. I don't think I have any further questions on this one, but Nimish, I hope I have answered your question. Okay. Now I am going to the next slide, which talks about ESOP modification. Okay. What is an ESOP modification? When you change any terms of your original granted ESOP, that is called as ESOP modification. This modification can be beneficial to the employees, or that modification could be not beneficial to the employees. That's how it is. Okay. So for ESOP modification, I would like to tell you one example. There is a company, the fake name, I will get, Bright Labs. Okay. It's a growing health tech startup, and they had given like generous ESOPs to the early employees. Things were doing really great until the markets cooled. The IPO was delayed, and the company's valuation dipped. Suddenly, those stock options felt very less valuable. So what did Bright Labs do in that case? They modified the ESOPs. So, as I told you, ESOP modification just means changing the original terms of the options. It can be done, to motivate the employees, retain the key talent, and adjust to the new market realities. There are three real world options which Bright Labs explore, that how they could do the ESOP modification. First is changing the exercise price. Originally, the employees could buy their shares at rupees 200, but the markets had shifted and the new investors were valuing this company at rupees 120. So Bright Labs decided to lower the exercise price from 200 rupees to 120. So that they did a beneficial modification for the employees. What did it change? This made the options meaningful again and help retain the key team members. Second option they tried was extending the exercise period. So your grant would be for 7 years. After 5 years or 4 years, the vesting was completed. Say, for example, after 4 years, the vesting was completed. And then you were left with 3 more years, which for exercise the options. Like some existing employees of the Bright Labs had stock options which were very close to expiry. That is, the grant period was expiring. But they were not in a financial position to exercise them yet. So what Bright Labs did is they decided to extend the exercise window from those 90 days which were expiring to 3 more years, giving employees more time to plan, to act, and manage their cash outflows. It showed empathy and ensured that loyal team members did not miss out because of the short term constraints. And the third option Bright Labs tried was re-granting or substituting the options. So, some employees had options which are underwater options. So, what is an underwater option? Where the exercise price is higher than the current value. So, Bright Labs cancelled those options and re-granted the new options at a fairer price with a fresh vesting. That's how they did that. So Bright Labs did all these things. They made their employees happy. But what about the accounting and disclosure? What did the finance team do? So let's talk about that as well. So when Bright Labs did this, this modification also came with rules and responsibilities. When the ESOP beneficial modification happens for the employees, at that time, you had to recalculate the fair value of the modified options using valuation methods on the modification date. So when that exercise price was changed, the new fair value of option was calculated because the terms of the options, that the terms of the grant letter were changed. Then, of course, there would be an extra cost. Yes, that extra cost was recognized in the P&L over the remaining vesting period. Of course, that also meant the disclosure changes. Uh, there was changes in the financial statements disclosures as per the accounting standards Index 102 and IFRS. And why this ESOP modification mattered is that helped to rebuild the trust with the employees. It made equity valuable again and it aligned everyone for the long haul. So employees appreciated Bright Labs was adopting the plan for today's reality and not just sticking to the outdated terms. So the final takeaway from this slide or the same ESOP modification example was ESOPs are not set in stones. When done thoughtfully, these modifications they can definitely boost morale, retain talent, and keep equity very meaningful. We just have to make sure that we account for it, disclose it, and communicate it clearly. Those are the 3 points which we need to consider. I'll just look into if there are any questions which we have got through it in this. Okay. Parth is asking, can you please repeat the underwater option? So underwater options are nothing but options where your exercise price is greater than the current market value. So when you try to exercise the option, your market price is 50 and your exercise price is 100, then your options are underwater. That's what they are called. Okay. Thank you, Rekha Damankar madam, for your comment. Really appreciate that. Sagar is asking, can vesting period be ignored if during minimum period of 1 year of vesting, some mergers and acquisition happens and entire company is getting sold? Uh, we technically cannot ignore the vesting period. I hope I've understood your question correctly. Maybe we can take a look at it in the question answer session for sure later on. Okay. Now I go to the next slide. The next slide talks about the ESOP valuation. I think in earlier question answers in the chat bot, I had received some questions about the ESOP valuation, that how the valuation is done, why it is done, what's the applicability of it. So we will be taking care of the ESOP valuation session in this thing. We just see. Okay. Paridhi is asking, is there any ESOP agreement which has to be prepared and signed by the company and all the employees? Yes. Every time the grant letter you get it, you have to actually, go sign it and submit it to the organization. Let's take a look at the ESOP valuation now. So another startup which I want to talk about, of course, the name is fake. The name of the startup is Fino. It was doing really well. They had just raised their Series A and their team was growing. And the founders wanted to reward the employees ESOP. But before they could issue options, their CFO said, wait, we need a valuation first. Everybody asked, why do we need a valuation? CFO said, here is the simple reason. Because ESOPs have value and that value affects both the employees and taxes. In India, the valuation is required to decide the fair price at which the options are granted, which is called the exercise price as well, to avoid the tax issues for the employees when they exercise the option. Because when you exercise the option, how much tax do you pay? The fair market value of the option minus the exercise price. And where do you get the fair market value from? You get it from the ESOP valuation. And the third point, comply with the legal and accounting standards. So like Companies Act, Income Tax Act, Ind AS, that's why you need it. So there are three reasons why do you need an ESOP valuation. To decide the fair price, avoid the tax issues, and comply with legal and accounting standards. Is ESOP valuation done? So they had two parts to deal with. For accounting and compliance under the Companies Act, they needed to calculate the fair value of the option for reporting in their financial statements. That is usually done using models like Black-Scholes, binomial, which we saw in the earlier slides. And these are disclosed as per Ind AS 102 in India and in other countries as per IFRS 2. And for tax purposes, when an employee exercises an option, the tax is calculated on the perquisite value. That is the difference between fair market value and the exercise price. So they also needed a fair market value report. And this is generally certified by a category 1 merchant banker registered with SEBI. So that's how we got to know how the ESOP valuation is done. And what do you generally need for this ESOP valuation? So you need projections for the company for the next number of years. And these projections can be built in. You also need your latest cap table. That is your latest capitalization table. Who holds how many shares? What is your ESOP? That's how it is. Who can do the ESOP valuation for it? So Fino, the company which you are talking about, they can't just estimate the value themselves. They brought in an independent valuer, typically, as we talked about, a SEBI registered merchant banker for tax valuation under Rule 11 UA, or a registered valuer under the Companies Act for accounting purposes. These experts analyze the Fino's financial statements, they analyze the projections and market data to arrive at a fair market value of share per share. What happens after the valuation is done? So, fine, you have received a fair market value. What are you going to do with that? So, Finnovo used this valuation to set up an ESOP grant price. They reported this fair value into the financial statements. Employees were informed of the tax impact when they are exercising the ESOPs. Everyone felt confident knowing that the process was very transparent and fair. So, the big takeaway from this ESOP valuation is valuation isn't just a formality, it protects the company and the employees. It ensures that the ESOPs are granted at a right price and taxes are handled right, and everybody and everything is compliant. Most importantly, it shows that company is really serious about doing equity the right way. I think we have gotten some question. So ESOP valuation is to be done every year on the date of vesting or by the company, also at the end of financial year as well due to MCA compliances. So you have to do the valuation at the time of grant. That is the grant date valuation is required. That grant date valuation, you will use it for that grant for during that vesting period. So you don't do the valuation at the vesting, but you do it at the grant date. Whether the valuation is actually required for listed entities. Uh, so for listed entities, then separate valuation is required for tax purposes when the ESOPs are exercised. The fair market value is considered to be an average of opening and closing price of the company shares on the stock exchange. We did the valuation in the Finnova's case because that company was not listed. The ESOP valuations need to be done on each exercise data also. No, ESOP valuation is not required on the exercise date. It is already done at the time of the grant date. So the difference between listed and unlisted companies for the ESOP valuation is uh, for the tax valuation in listed company, it's not required. You can use the stock price. But in unlisted company, it is required. In accounting valuation, that's required under Ind AS 102. And that is required in both the companies. That is listed companies and unlisted companies. That's how it is. Okay. If there are many more questions. Yes, Bhavin. So Bhavin has asked about whether the equity share valuation is required from a registered valuer as on the date of the grant of ESOP. That's right. Equity shares valuation is required from the SEBI registered category 1 merchant banker as on the date of the exercise for perquisite amount and perquisite taxation. Yeah, that would be required as well. Okay. We will just move on to the next slide. So the next slides, I would like to talk about these ESOP management tools. So when you are a part of finance team and you are managing ESOPs, how do you manage that? What are the different tools available in the market? I will be not taking the names of any tools. All tools have their own disadvantages and advantages. That's how it is. But so your company has launched an ESOP plan. Great. Now comes the real task, like managing it well. So this is not just about issuing options, it's about keeping the track of grants, vesting, and exercises, staying compliant with the laws and audits, and communicating clearly with the employees. And that's where the ESOP management tool comes into picture. So what are the main approaches of managing ESOPs? Let's go back to our old example called Novatech. You know, there's a company called Novatech and it's exploring its options, that which tool is the most beneficial tool for them. They're trying to decide how do they best manage their growing ESOP programs. First is in-house management. The finance team says, they will do it everything manually using spreadsheets, Google Sheets, emails. Of course, there are advantages to it. This is very low cost, and finance team is in full control of the numbers and the amounts. What are the cons to it? How the scale increases, at that time it becomes really very time consuming. It is prone to errors. It is not a scalable model. It is difficult to handle compliances and audits because you are actually managing spreadsheet with 3000 lines. It becomes difficult to manage. Why in-house model is good? It is really good for the early stage startups with like a small ESOP pool and limited activity. What is the second option? The second option is outsourcing to a full service provider. So Novatech explored, how can we explore it to the ESOP management or a dedicated firm or a legal partner. These dedicated providers, they handle the cap table, that is who has invested at what date, which percentages. They also handle the ESOP tracking. They handle the valuation, they handle the filing, they handle the documentation. They also handle the employee communications and support for queries. What are the pros? It saves a lot of time for the finance team. Their bandwidth is increased. Of course, this is handled by the experts because these data providers employ the niche workforce who have knowledge of these ESOP tools and ESOP conditions, ESOP taxation, who has knowledge to it, which might not be possible within the finance team. What are the cons? It can definitely be expensive, and a finance team has less visibility or control on the things. Then they also have, always have this third option, which is available, which we are going to talk now. But the second option of outsource, it gives them the companies who want peace of mind and do not have the internal bandwidth, that is the best option, outsourcing it. What is the third option? That is in-house, which is external consult, in-house plus external consulting. So this is a very hybrid model. What happens in this model is you have some internal systems, and for complex parts like valuation, taxation, modification, policy designing, that time consultants will come into picture. What are the pros of this thing? So there is a balance between control and export input. So at the same time, the finance team has a control over the ESOP, and in addition to that, they could refer to these external agencies if they get any queries or if they get any complex matters to look into. This is very cost effective compared to the full outsourcing model. And of course, this is customizable. So you can outsource some part of it or you can keep the some part of it. So that's a very hybrid model. What are the cons? This still requires internal time and effort. Definitely, because you are managing it in-house, you are the responsible person for that. And there is a lot of coordination which can be time consuming, which is needed between teams and consultants. It is very good for growing companies that want flexibility and expert advice without full outsourcing. That's how. There are very different tools which are available in the market. Uh, I have worked on some of the tools. Every tool, as I said, they have their own, pros and cons of these managing tools. So some of the tools also support the buyback. And in case of buyback, I'll tell you how do they support us. For buyback, there is a lot of communication which happens between companies and the employees. Company has to send an communication first that we are exploring the buyback option. The second thing, company has to communicate to the relevant employees who are impacted by buyback that, for example, I'm the employee and there is a company. The company tells me you have 100 shares or you have 100 options which we want to buy back. I might have 1,000 options as well, but only 100 of them are eligible. So then I have an option that employee has to communicate to the company that out of 100, I want to choose all 100 to be bought back. Then company will send an agreement to the employee needs to sign, return it to the company needs to sign and return it to the employees, and then the communication for the payment happens. Then if there is any TDS which is to be paid, that needs to be deducted, and that needs to be added into the pay slip and be communicated to the employees. So this requires a lot of to and fro. And a lot of ESOP management tool, they're actually providing this facility that you do this, you track this in from these ESOP management tools. So they also and these ESOP management tools, they also offer like dashboards for the employees as well to view their equity. So I have seen scenarios where if I have exercised shares of the company and I have left the company, I still have access to the ESOP management tool. And in that ESOP management tool, I would get to know what are the values of the shares right now because the company is not listed yet before IPO. And the whole buyback scenario, like buyback of shares, that time also it will come into picture. Those dashboards are very helpful. There are automated vesting schedules, there are alerts for grants, exercise dates, expiries that could be triggered from the ESOP management tools. Cap table management happens there, and the compliance and the reporting features are also included into that. And it's very good for companies who are ready to scale. They want to bring a transparency into their equity programs. So what is the big takeaway from these ESOP management tool is, so managing ESOPs well build the trust with the employees. Whether you do it in-house, outsource, use a software, you know clarity and accuracy matter. As your company grows, please do consider investing in tools because that would free up your bandwidth. All the past issues that is being like, the handholding of information, which might not happen during the handovers, resignations, the tool will take care of it. The tool will have all the old information, and that serves like a very good purpose. So that's about the ESOP management tools. I think we are towards the end of the session now. Uh, I'm very happy that I was able to cover a lot of things which I wanted to cover in the session. Yeah. Yeah. Vishal, if you have a question, that please do suggest some good tools to manage ESOPs. I don't want to take any names. Uh, That's why I don't want to suggest this in the session. Maybe you reach out to me on LinkedIn and I will definitely suggest a lot of a lot of tools which I've worked with. Every tool has their weaknesses, their advantages. That's how it is. Uh, I have got one question from Rajashri. Uh, Employees who receive ESOPs have to sell shares to cover taxes outside India. ESOPs have to sell shares to cover taxes outside India. Okay. They are sold to pay perquisite tax, right? If yes, can you explain how is this process handled by an Indian company with respect to TDS? So Mij is asking, I'm sorry, but Rajeshri, I did not understand your question. Okay, so Umesh is asking, what is the logic of giving loan to trust? So the trust, when you are transferring the shares to the trust, right? It's a separate entity for you. So that's the reason when you're transferring the shares, you also extend the loan to the trust. That's how you do it. I think how can we get this PPT? I think you can get this PPT. WRC would be posting the video and the PPT on their website. That's what I got to know. So they would definitely do that. Yeah. Please explain how the difference in fair market value and exercise price is expensed out. How is it accounted in the company books? Okay. Yeah, Rekha madam is saying that they will post it on the website. So the perquisite, I'm talking about the perquisite query. Uh, the perquisite which is calculated and taxed to the employee, which is the difference between fair market value and the exercise price, that can often be claimed as deductible business expense by the company. Okay. Yeah, Parij, I think let me just see if I'm able to show you how this calculation is done. I will just go to that page again. Yeah, that's the page. I will also see if I'm able to get the Excel calculation, which I had done earlier. Yeah. So I think I would love to share this, the calculation which I had done. This is not a browser style ESOP calculation, it's just any other ESOP calculation. I hope you are able to see my screen. In this screen, the ones which we have calculated, I've shown it how this calculation is done. We'll start from the beginning. We have number of units which are 100. The fair value of each unit is 400 rupees. Total cost is nothing but 100 into 400, which is 40,000. The grant date is 5th of May 2021. And these are the next vesting dates. These are 4th May 2022, 23, 24, and 25. Okay. Now, what will happen in financial year? I'll just change this financial year because I've done some future calculation. It had it, right? What will happen in financial year 2022? How many days are there from the grant date to 31st March 2022? It's a very easy calculation. It's nothing but, sorry, it's nothing but your 31st March 2022 minus grant date, which is 5th of May 2021, plus 1. That's the Excel calculation. So 331 days are calculated. How is 9068 is calculated? Is this grant, which is vesting as 4th of May 2022, what is the value of the grant? It is 10,000, 25 shares into 400. Out of this 10,000, how much is booked in 31st March 2022. So total grant days are 365. How I have calculated the total grant days for this grant is grant date to 4th of May 2022, which is number of days 365. Out of that 365 days, 331 days I have to account for this grant portion in financial year 21-22. What I did was I divide 10,000, the total cost, by number of days of the grant, which is 365, into number of days applicable in this financial year 21-22, which is 331. That gives me a number of 9068. I follow the same policy for the second grant, where the number of days grant period is increasing to from 365 to 730. How it is increasing that? The difference between 4th of May 2023 to 5th of May 2021, 730. And so this grant is for 730 days. Out of that, you are going to accrue for only 331 days of grant. So that comes to about 4534. Similar way, we will do it for 4th of May 2024 and 4th of May 2025. That's how it is. So on that basis, we calculate in the year ending 31st of March 2022, we are going to accrue for 18,888 rupees in the year 21-22. So this is how it is calculated. Now, in the second year, as I mentioned to you earlier, there is always an incremental accounting which happens. How does the incremental accounting happen is, now you go to the next year. The next year end is 31st of March 2023. Then you calculate the number of days between 31st of March 2022 to grant date, because the incremental accounting is happening. What are those dates? 696, which is nothing but 2 years plus some days. That's all. Or so not 2 years plus days, 2 years less some days. What happens in the second year? All the 4th of May 2022 grants are vested. So the calculation is going to be 25 the number of shares into 400 rupees. So 10,000 will be the second grant is not yet vested. It is vesting in 4th of May 2023. So similarly with what we calculated in the first year, we will calculate the number of days 696 into the grant cost for 730 days. So into for 1 day. That's how we'll calculate. So what the calculation formula is, 10,000 divided by 730. That will give you a grant per cost per day into 696 number of days. That's how. Similar way, we will calculate for 4th of May 2024 and 4th of May 2025. So I have again bifurcated this into vested and future vesting. In the first year, everything was future vested cost. But in the second year, I have some portion of it that would go. Sorry, I'm not able to copy this. F9. That would go into vested. And how do I calculate the cost for financial year 22-23? It's going to be total cost, which is nothing but 30,648, minus the cost which I've already accrued for in the first year, which is 18,888. So if you look at the formula, it says this total cost minus accounted for. Similar way, we do a calculation for next years. And you can see that by 31st March 2026, everything would be vested for you. I'll do one more thing. I'll just change and what I did was I just changed the vested cost. Now this is future vesting. Now one more check is whether the total cost is 40,000. It is increasing by 40,000. No, the total is 40,000. And how much we are going to accrue for 40,000? You decided on this total 40,000 cost on the grant date itself. It's just the way you have bifurcated it into vesting. I'll just see if there are any questions. I hope I was able to take all your questions. I think we still have some time left. Any accounting to be done post vesting and exercise of the options. So post vesting and exercise of the option, there is no what do you call it? There is no accounting which is required because the accounting is already ongoing when you granted the options. That's how it is. The only thing is there are other factors to it. Say, for example, the accounting will stop if somebody leaves, and then all these shares which are vested, only vested cost will remain in the books and the unvested cost will be reversed. That's how it will happen. Can you explain the accounting implication and Companies Act 2013 provisions or requirements in a case wherein ESOP is made part of monetary CTC? For example, the agreed, okay, sorry, just a minute. For example, say the agreed upon CTC is rupees 100 and the company wants to park rupees 40 under ESOP, in which case the cash payout of salary will be 60 by the company. So what to do of the balance rupees 50? So this balance rupees 50, you are accruing for it as ESOP cost. As you've seen in earlier slides, this is tagged as employee benefit expenses. So this is coming into your P&L as employee benefit expenses, but it is not coming as your salary. It is coming as ESOP expenses. I have one more question. Who are not employees or employees working from less than 1 year? So in India, ESOPs can be given only to the employees. But I've seen in other countries, ESOP can be given to the consultants. So I've seen in Ireland, the ESOP could be given to the consultants. In directors also get it, managing directors get it, though are not on the employment contract. But in India, it can only be given as to employees. Okay, I'm going through some other questions. I think they went little old in the history. There is a question from Somesh. I think he's mentioning who are not employees or employees working from less than one employee. So ESOPs can be granted for employees. The tenure of the employees depends. You can have an employee for less than 1 year, but that ESOP will not be vested for them. So that all that cost you need to reverse out. That's how it will happen. If it is a future vesting cost. If it is a vested cost, you don't need to reverse it. And when you're doing the buyback, right, you will have an ESOP outstanding reserve that you can actually utilize for the buyback purposes. Bhavin, just continuing the above question, the balance of 40 is debited to P&L, which ledger is to be created. So technically, when you mention this 40 is the total ESOPs granted to you. So the total ESOP granted, say for example, 40,000 rupees. So that will be accounted for in the books in 18,000 in 1 year, 11,000 in the second year, third year 6,310, fourth year. So that's how it is going to be accounted for in the books. The whole 40,000 will not be accounted for the books in the first year. So it may be a part of your compensation letter, but that's not a cost to the company immediately. It gets spread over 5 years over the vesting period. If we grant ESOPs anytime, even to new joiners, but employee cannot exercise them before 1 year from the date of the grant. Yeah, that kind of conditions can be set up, that when you can exercise the ESOPs, that is possible to be set up. I think, Somesh, in your sentence, you're not talking about the vesting condition. Vesting condition is also important. Unless your ESOPs are vested, you won't be able to utilize them. I think I'm getting a question about the differences between Indian accounting and Ind AS or IFRS. It will be like a very detailed session. Uh, Rekha madam, we can have another session for this Indian accounting standard gap and IFRS gap. We can definitely do that in the upcoming days. Oh, thank you, Nimish, for your kind words. Thank you, Sarah. Ronak is asking, can ESOP be transferred after completion of vesting period? So this totally depends on your company. As we earlier discussed in one of the scenarios, companies may or can allow their employees to trade their shares outside of the markets as well. uh, as in outside, like outside the company. Say for example, I have some shares of the companies, and I decide to sell those shares into the market. But of course there should be a buyer available to buy those shares, and it also depends on the companies. A lot of companies do not allow that to dilute the capital base. Thank you, Jigna. Thanks for your kind words. Thank you, Saurabh. Just do let me know if I've missed out any questions, because they're going into history. I think Saurabh has already planned a session for accounting as per Indian Gap and Indes. Yeah. We can definitely plan one. got one question from Somesh. There shall be a minimum period of 1 year between the grant of options and vesting of options, provided that in a case where options are granted by a company under its employee stock option scheme, in lieu of options held by the same person under employee stock option scheme in another company. So we can give ESOPs to any person. Let's say he or she worked only for 1 day. So it's a very detailed question, but what I understand the question is whether we can give ESOPs to any person. Let's say he or she worked only for a day. Yes, we can give that to anybody who has worked for less 1 day. But a lot of times, company rewards, like company uses ESOPs to reward the longevity with the company. So the longer you stay, more you contribute to the company, there you get to know, there you get more ESOPs. So though you worked only for a day, your ESOPs might not be, granted or vested. So I'll tell you a live example. In a company where I have given ESOPs to somebody as a company, the vesting would start after a year. So I would ensure that the person would stay for at least a year for the vesting to start. Maybe at the time of vesting, there would be a big chunk which would be vested for 1 year, but the vesting doesn't start if the are for 1 year for sure. What's the compliances by Indian subsidiary company whose employees got ESOPs of foreign holding company? Yes, there are a lot of compliances. There is RBI compliance which you need to do. There would also be compliances at the holding company level uh, to their banking authorities like RBI, which we have. Those compliances will come into picture. Ronak is asking, is there any time band after which ESOPs cannot be exercised, though vesting period is completed? Yes, definitely. So that depends on your each grant. So each grant has a grant period. And if all the shares are vested and you have not exercised those shares till the time the grant period is over, your ESOPs are lapsing. That's how it is. At that time, these ESOP modification will come into picture because a lot of times what employees do is, they know that their grant period is expiring. Then they come back to their they come back to their companies and they ask for an extension that you extend my grant period. And a lot of times this extension is granted. When you do an extension, it is a ESOP modification. So of course, this is an additional cost to the company, but companies do these kind of modifications for sure. Okay. Parth is asking, can you brief more if possible? I'll just see, Parth, what was your question? What are the compliances by the Indian subsidiary company whose employee got ESOPs of foreign holding company? So there is a RBI compliance, which is there. No, it's a 6 monthly semi-annually compliance for RBI, which you have. I'm not sure the name of the compliance, but I can get back to you on that one because that compliance is done. Okay. Yeah, Path, please do reach out to me on LinkedIn. By that time, I'll find out the name of the compliance as well, which we do. Thank you so much. Thank you, Yogesh. Yeah. So I think Chirag is asking me some question. He's asking me about whether the fair value and market value is different. So when you do the accounting, you do use a fair value of option. So that is calculated basis the market value. So fair value of option is different and market value is different.
Any other questions? Am I audible?
Yeah, we can hear you actually.
Yeah.
Rika madam, we can hear you.
Any other questions?
I think Saurabh had a question.
He had a question that can you explain trust root ESOP vesting using
I found it.
an example?
And
How
how
is
is
the loan interest
paid
paid
by
by a trust at what point and what point TDS is deducted?
TDS is
That's what
deducted? Okay. Yeah. So I'll give you an example for you. Uh, say for example, there is a company had set up an ESOP trust. The trust buys 10,000 shares from the company at rupees 100 per share. The trust takes a loan of that 10 lakhs from the company to buy the shares. Then there is an employee who is granted like 1,000 ESOPs with a 4-year vesting period. And year one, there is 250 vesting. At the end of year two, there will be in total 1,000 vesting, which is happening. So the trust owes loan and interest to the company, but the trust technically does not generate any income. So it recovers the cost when the employee exercises their ESOPs. So let's assume employee A exercises 1,000 shares at rupees 100 per share. Market price is 200 per share. So employee pays 1 lakh rupees. How is 1 lakh is calculated? 100 shares, 1,000 shares into rupees 100 per share. And this trust uses this 1 lakh to repay the loan principal and or interest to the company. If the interest is higher, the trust might need additional funding or defer the repayment. Generally, what these trusts do is when you are transferring them the shares, right? They are not transferred at the 100 rupees, but they are transferred at the lower price because they are transferred earlier and then the employees are buying it at a different time. So maybe 2-3 years down the line. As I mentioned, there is year one vesting, year two vesting, year three, and year four. So at the time of year four, the value of the shares has definitely increased. So that's how it happens. I hope I was able to, close out your question. Thank you, Ronak. Thanks. Oh, I was able to close it. Thanks. Thanks, Zara. Let me just switch on to the. I think we do not have any more questions, and I'm really happy that we were able to cover everything into this session. It's been 4 minutes before 7 p.m. I wasn't sure whether I was able to do that, but it was a really good experience for me, for sure.
Yes. So, Rati, on behalf of WRC, we are grateful to you, really grateful to you. And I listened couple of Wow series, and I moderated also couple of Wow series, but this is the one which got, I think, highest number of questions,
Is it?
and and which got the highest number of resolutions also. So you referred all the questions, you answered all the questions, and although the topic is very technical, very difficult to even explain, for me, I'm a forensic auditor. For me, I don't know anything about the ESOPs, frankly speaking. But for me also, it was a very pleasure listening to you, and I could understand a lot of things from you, and I could learn a couple of things on ESOPs. So thank you very much. So जहाँ पे हो वहाँ पे तालियां बजा सकते हैं हम लोग. Let's have a big round of
Thank
applause
you so much.
to
Thank you so
Rati.
much. I
And
really
Rati, I would like to have your session offline from on at Pune branch or at any of the branches, or WIRC will definitely have your offline session, because your expertise in this field is really fantastic. It's
definitely.
fabulous.
I
And
would
the
love
way you
to meet.
explained, the
Yeah.
way you explain, the way you handle the queries, the way you referred the questions in between and answered them and have made it interactive, it was really amazing. So it was one of the unique sessions we had in WOW series. So thank you very much. Thank and from bottom of my heart, and from on behalf of all the participants here from WRC also, thank you very much. Would like to see you one again and again.
Definitely,
I will
definitely.
definitely arrange the sessions on IGAP and INDES, and as per the requirements of the participants. So thank you very much. Thanks all who have attended this session, and thank you, Rati, especially. I'm overwhelmed. I'm amazed by your session, frankly speaking. So thank you very
Thank you
much.
so much. It's really nice. It was like a busy week. Uh, uh, I think it was finalized only last week, but I was, very happy to note that it went well. And thanks to the participants. Actually, I was not expecting a lot of questions. People generally doze off, but I've
Absolutely.
a lot of questions. I think that questions actually, planned for the next session. So that's what I think. But I'm really happy, and it was
Yeah,
arranged.
actually, when this topic, I heard about this topic, and I was asked to give word of thanks or to moderate this session. I thought कि this is not my cup of tea. मुझे तो कुछ समझ में आने वाला नहीं है, and I could hardly bear it for 10-15 minutes, because this is not my the area of expertise. But I listened to for 2 hours.
Oh,
So
that's nice. I'm really happy.
yes, thank you very much. Thank you all the participants. Thank you, Rati, and see you again.
Definitely, definitely.
Thank
Thank
you.
you, Rekha madam, and thank you for all the participants. Though I'm sure you cannot speak, but your questions made a lot of sense. So thank you so
They
much.
will soon listen to you offline.
Definitely.
Thank you. Thank
Thank
you very
you.
much. Bye
Thank
bye.
you. Bye.